Hello everyone, my name is Kamal Manocha, represent PMSAIF World, taking the rhythm of Friday webinars ahead. Today we have another very interesting webinar planned with Mr. Vineet Jainn, who is CIO at Volvin Limited. It's a very unique and very differentiated strategy that he has created. And maybe today, the kind of markets we are in, we are absolutely euphoric. Markets are very euphoric. It is very interesting to understand the covered call strategy based fund that he has created, which is India's number one fund. This is a conservative equity strategy which delivers superior risk adjusted returns and has high Sharpe ratio. BlackRock defines covered call strategy as making more money by losing less. Let's understand, from Mr. Vineet Jain, who is the CIO at Volvin Limited, what is this covered call strategy? This particular webinar is more about understanding this strategy because, it is like sounding very interesting for almost all types of investors who today are wanting to add more, increase the share of wallet in equity, and obviously are worried because market valuations are high. And also those conservative investors who kind of, are not settling with returns in FDs or with arbitrage funds or other absolute return funds in long short category. This fund could be interesting for those investors as well. So just to maybe give you 2 more minutes of background, Mr. Jain wishes to prove to the conservative investors that higher returns can be achieved with lower risk. He wishes to instill confidence amongst investing community that derivatives are not merely speculative but can be used for hedging and return generation. Covered call strategy is an effective tool to do all that, and he brings with him 30 years of experience. He has seen 3 market cycles from the dot-com bust, or before that the Harshad times and the last subprime crisis, and obviously the recent past, which is pandemic crisis. And he has been an investor himself based on his own practical learnings of how investor goes through the turbulent times and experiences in various market cycles. He has created this strategy, and I have met him personally. I have interviewed him a couple of times in the past, but obviously over time, his own positioning of his fund is gradually becoming more and more sharp. And I am wanting to understand from him by way of presentation today, what is this covered call strategy all about? And we have heard of this concept of rentals in real estate, whereby one can own real estate property and also kind of earn a gradual income by way of rentals. One has never heard that of in equities. Covered call strategy, something like that, whereby you're owning a portfolio of equities, you're not wanting to sell it. At the same time, in range bound markets or maybe markets which are at high valuations, there's a way to make higher returns through equity rentals. This is something like which we call as covered call strategy. More will be explained by Mr. Vineet Jain. Mr. Vineet Jain, over to you. I am giving you access to the presentation. We'll first do presentation and then we'll do Q&A. Over to you.
Thank you, Kamal. Thank you for the kind introduction. And I'm envying we are sitting in such hot weather and you are enjoying the beautiful weather. A river flowing behind you and green mountains. But yes, what we want to achieve from this webinar is green. Green is the color of money. Let us see how much money we can make for our conservative equity investors, and not just equity investors. The theme for today is equity rentals, versus property rentals. So there's a huge potential for even long-term property investors to take benefit of equity rentals. Why we don't lose money in property? Because you would have hardly seen people saying कि मैंने कल property खरीदी आज बेच दी या सुबह ली शाम को बेच दी. The view for investing in property is always very long term, and in this very long term hardly anybody loses money in property. Same is the case for equity. If we are willing to have this kind of patience in the long run in equity, there is a huge wealth that can be created, and this wealth is much more than what even investors in property can create, or investors who invest in property for property rentals can create. So without much delay, I would want to start with my favorite quote: compounding is the 8th wonder of the world, by my favorite person, Albert Einstein, who has motivated millions of people across the world. And so starting slow, if we try to understand what are the returns from various asset classes, we will see that equity in the long run, in the last 3-4 years, the scenario is pretty different. But in the long run, in the last 30-34 years, Nifty or 50 or equity or large caps, which are, blue chip companies, have created a return of 11.7, 11.8% only. So this only is not a small number, it's a great number. But because today 60% of the demat holders or the investors in stock market are very young, their age of investing is less than 4 years in the market, to them this 11.7 or 12% seems a very, very small number. But actually this number is a very big number in the long run. And we are going to share some data which will be some kind of caution to these very young investors who expect 11.7 or 12% return, not in a year, but in a month. So if you see Instagram, it is flooded by people or companies promising 30%, 100%, 300% return, not in a year or 10 years, but in 1 month. So, it is one indicator that we are heading towards something known as overvaluation or euphoria in the market. And we have seen in the past too, it happens. I have seen it in Harshad Mehta time when people believed it's never going to crash. I've seen in .com that one website, was launched, and a website that time didn't cost much, but simply a launch of a website could increase the market cap of a company by 700 crores. And we are seeing, these things happen day in, day out today. So equity gives about 11.7, 12%. SIPs in equity give slightly more at about 15. Gold has been a star performer in the last 2 decades, almost 12, 13% return. These are approximate returns. Fixed deposits, 8% right now. There's a shortage of capital of deposits in the banks. Unsecured debt can give anything from 10, 11, 12, or even more, and it is unsecured. So the more the returns, the more risky it becomes. Real estate, people assume that real estate gives great returns, but we have to understand that real estate itself has about 5 categories in it. Plots in rural give the maximum returns in the long run, and especially during a time when they are getting developed. So plots in urban have a return similar to inflation, and property in this urban or developed area, this is constructed property, has a return that is lower than inflation. It could be 4, 5, 6%. Some areas could be more, but this is a general return. The return is lower in these developed areas because there's a depreciation and maintenance cost also involved in these. So, and the last two are rentals. So rentals in commercial area, we have about possibly 4 to 5% return in property price appreciation and maybe 4, 5, 6% in rentals. Similar is the case for property in residential areas, which are established areas. We will see less than inflation returns in these areas, but also a rental in residential areas could earn in a year about, so for the new investors, these numbers are not monthly numbers, these are annual numbers. And the returns are about 3 to 5. These are approximate returns. If you Google it, you will find all sorts of data, and this is the average, approximate average returns taken. So important fact to be noted here is that any investments we do, we have to keep in mind that those investments are job. When we are investors, we want returns, and the inflation itself is a sticky 7%, and globally inflation is becoming very, very high. So whenever we are looking for returns, the returns must be more than inflation if we want to create actual wealth. If you want to know more about wealth creation, we have some earlier videos which you can search, Volvin Limited, Vineet Jainn Wealth Creation on YouTube. And it talks much more in detail about wealth creation, how wealth can be created over a long time, and how inflation figure is a very, very important figure to track. Because if you're making returns of 6, 7% lower than inflation, those are not returns. We are actually destroying value. So returns from property, I already indicated. So if we add both the returns from property appreciation as well as rentals, we will get a return of roughly about 3 to 5%, from rentals. The total returns from property and rentals could be 7 to 11%, which are slightly higher than inflation. So people who want income and they want better returns, they can have a property, let it appreciate for long run, and also put it on rentals. So returns from equity, as we all know, are about 11 to 13%, 11.7% to be precise for Nifty 50. And from large cap, from equity, it is about 13%. From SIPs, they are slightly more. But what are the returns if we enter into a concept of equity rentals? That means owning equity and trying to earn some returns on a monthly basis. So first is the example from property rentals. Let us say the returns we assume were 4-5%, or let's say maybe 0.5% a month. Now 0.5% is not a small number. So if we get 0.5% rental from property, it translates into, everybody can calculate, 6% returns annually. So this return on top of the property price appreciation of 4-5% could mean 8, 10, 11, 12% returns from the property in the long run. But what are the returns from equity? Can we get 2% a month? Can we get 5% a month? Now, these are very, very big numbers. But if we translate these into annual returns, a 2% return becomes 24% return, and a 5% return per month becomes a 60% return. So is it possible to get such high returns? Maybe, maybe not. But these are just illustrations to help you understand what returns from equity rentals could be, to understand the concept. So equity rentals is a concept which is very, very similar to covered call option writing strategy. And we are the first fund, Volvin Growth Fund is the first fund in the country which is focused on equity rentals or covered call option writing strategy. So now, what is this covered call strategy? Again, people who want to understand it in detail can search our webinars with various people, with also Kamal and his team, PMS AI World, on the YouTube, and you will get. So what is this covered call strategy? Is it popular? So yes, definitely it is popular, and more so in USA. And there are the global funds working on covered call strategy. These are the, it's almost a $500 billion industry in the US. So we have fund from Global X, that is Mirae Asset, JP Morgan, 20 billion, 6 billion, 2 billion, Global 1.4 billion, BlackRock Energy and Resources Trust, 0.4 billion. It's a very small fund, but something very, very interesting. And they say on their cover page, making more by losing less. So Kamal, you already summarized it. So we are not saying this. BlackRock says making more by losing less, the case for equity covered call closed-end funds. And what they say in fine print, that this strategy can help to manage portfolio risk and potentially produce a better risk-adjusted outcome. BlackRock believes a covered call strategy may reduce volatility in your portfolio. It can reduce portfolio volatility by capturing option premiums without having to sacrifice long-term performance. So all the good things that can be said is said by them. Now, what does this covered call option writing strategy involve? It simply involves, like we invest in a property, we make investment in a property. So in this case, you make investment in shares for long term. And instead of getting monthly rentals from the property, we have to sell call options on our investments, on our underlying shares. And these shares have to be from the future and options category. And every month, we will try to sell options on our portfolio. Now, this is not as easy as it sounds. It's very complex. We have tried to do it on our books in our, proprietary funds for a long time. And it was very, very difficult and cumbersome. And we realized doing it on an individual portfolio was giving us sleepless nights and, issues of in making more investment, balancing the fund, withdrawing funds. It was something very, very complex. And we were advised by certain experts in the industry that instead of running it on our own proprietary books, it was prudent to, start an AIF, an alternate investor alternative fund, which could help us streamline the whole process. So currently, we will buy from these 180 shares that are there in the future and options segment. We will make investment in these shares, and every month our team, which is very, very, I would say, hardworking and working a lot on making this strategy easy, seamless for our investors. There are a lot of systems and processes we've set every month. It sounds very simple, selling call options on the underlying assets, but we have a team of almost 12 people focused on this operations team, how to sell call options and how to trade on a daily basis. So every minute, every hour, every day the market is open, our job is to sell as many call options as possible, thereby earning. So these call options earn the premiums, and these premiums are similar to the rentals we earn each month. So in property, it is very easy. You simply get a check or a credit in your account. But for these, you have to work very hard. You have to do a lot of research. You have to study the technical, the fundamental aspects. And based on that, you will buy shares and you will sell call options on each of the portfolio. We try to maximize option selling try to sell it on the whole portfolio as much as possible. But, normally we achieve a 70, 80, 90% strike rate. And our team does it every month, every hour, every minute the market is open. So coming to, most people say, ke, baat to theek hai bhaiya, par, what is the money made? So this is the report card of the fund. But what I want you to focus is not on the whole thing right now. I want you to focus on the grid. In the middle, we have a grid, the boxes, which show, the returns we have made on the property side or on the equity side, the investment we made, and what we have made on the derivative side. So if I will just explain the graph to you, and if anybody wants to understand a little more, you can please type your question in the box, and we will try to answer it. So we have the date. These are monthly returns of Nifty and the fund. The Nifty, wherever it is green, it shows it has a positive return in the month. And wherever it is red, the Nifty 50 has given a negative return. And the next in the orange or the pumpkin color is the performance for the fund. But the grid is the most important because it breaks the total returns into two parts. One is the investment part or the equity part. And the second part, the second column in orange, is what we are earning by way of rentals. So if there are any questions, we can answer it right now also. But what it shows is that in equity side, we are not very different from Nifty. If Nifty is red, we are red too. And in some instances, our equity portfolio has done worse than equity. On a couple of instances, one instance is done better, but on a couple of instances done worse. So it is very similar to the Nifty performance, but it may or may not mirror what Nifty does. But on the derivative side, where we are selling call options, you will see that every month we have generated a positive return simply because when you sell a thing, you earn the option premiums. So every month, because we are earning option premiums, the derivative side has earned roughly, I would say, about 1.69. So this is the income, we've tried to break it up. So it's not 2 or not 5, but this is the actual data for the last year, 2023, wherein you will see 1.92, 0.96, so a minimum of almost 1%, but on a higher side of in April of about 2.5% on the derivative side. And what we can answer later on, Kamal, is very important if you can note it. What are the risk parameters? You asked that we are a fund. So we have the highest, the Volvin Growth Fund Active Rabbit has the highest Sharpe ratio in the country, even compared to all mutual funds. So it is even more conservative than mutual fund because the Sharpe ratio is a very high at 2.04 right now. And you will see the standard deviation is very low, which shows the volatility. So all the figures in the red are the risk parameters. The long shows that, we are never fully invested. We try to be on an average only 70% invested. So 30% is always on cash. On an average, number of stocks is very, very high, almost 65 stocks, which increases the diversification, reduces risk. CAPM beta is, unbelievable at 0.47, half of the risk of market. So we can come to these numbers later on if you want to ask. And the annual returns from call option now it has been about 19.1% in the last year, or an average of about 1.6% per month. So if we compare the last calendar year, so all these are gross returns, the taxation, the fees, everything is to be deducted from this. And I can share that in the last financial year that we ended, we had gross returns of roughly 30%, and the post-tax, post-expenses returns were about 25.1%, which was a taxation of about 15%, which is slightly more than long-term taxation, but almost close to short-term taxation on equity of about 15%. And the lock-in period for the fund is there is no lock-in. You can withdraw it, the next month, but there's an exit load of 2% till 2 months, and there's an exit load of 1% after 6 months. And selling options, somebody is asking, is it an unlimited list? So that is what covered call means. We invest and then we sell a call option. So it's not an unlimited risk. Whatever option we have sold will always come as a profit. You can refer to our earlier videos which explain how you will not lose money, because we are buying the underlying, we are buying the same share for which we are selling the call option. We will never have unlimited risk. So you can see in this particular slide, Nifty 50 is more popular. So people ask us, Nifty 50 se kya comparison hai? So you can see 1st Jan Nifty was 18,000 and 31st December it was 21,700. So almost a 20% appreciation in Nifty 50. But in the fund, we did about 27.2% gross returns. But the most exemplary thing is the beta of only 0.56. It has beaten both Nifty 50 and 200. But I will not say we've done exceptionally well on the equity side. On the equity side, because we are only 70% invested and sometimes we falter, we don't do well as the market. We are, I would say, we perform roughly 30 to 50, 60% of what Nifty does most of the time. So if Nifty does 10, we may do only 3, 4, 5, 6% return, So because we are 70% on an average on cash, so, and the portfolio may not do as well as Nifty, we will end up doing about 30 to 60% of what Nifty does. But on the derivative side, because we're selling call options every minute, every hour, every month, we will earn a certain return every month, irrespective of what the market does. So I would want to, summarize by saying that it's a very conservative equity product. It is 30% lower risky than even the equity mutual funds. And something, remarkable is that in case the market is stagnant, Nifty, we have many times in the past seen that Nifty remains, for 2 years back, 2021-22, Nifty started at 17,400, ended at 17,300, 100-point correction in the whole year. But our, proprietary fund did about 24% returns in that scenario. So that a stagnant market is an ideal scenario for giving maximum returns. So this is a comparison we have with the mutual funds. You will see that in the green, are the returns, and these are fabulous returns. The year has been spectacular, and last 12 months have delivered crazy returns. You will see returns of 20, 25, 40. So we've tried to take all kinds of top funds and their various, small cap, mid cap, large cap. And so how does an investor judge which mutual fund is doing better? So normally the parameter for us is, only returns, but a Sharpe ratio is something I will request all the investors to always check what is the Sharpe ratio for your fund, because the Sharpe ratio actually tells what is the risk a fund manager is taking, to create those returns, to give those returns. So a Sharpe ratio will take into account the standard deviation, the beta of the portfolio. So standard deviation and beta are a measure of risk in the portfolio. they show that, if the market is moving 1%, whether your, stocks are moving more than that, effectively telling us that are the stocks more risky than the market? Because if a stock goes up more than the market, when the market goes down, the stock will generally fall also more than the market. So beta and standard deviation are an indication of what, the risk the fund manager has taken, and a Sharpe ratio balances the return and the risk in the portfolio. And you will see that, a beta, for example, quant is very, very popular these days, and they are doing extremely well. But you will see that their beta is 1 plus. So they have a risk that is slightly more than market. But in spite of that, so you can see at 12, quant is 1.05, small cap at 22 is 1.06, and all other funds have beta much lower. But in spite of this high risk, churning or the portfolio they have been able to give an excellent Sharpe of 1.16 and 1.44. So great Sharpe ratio from them, and the higher the Sharpe ratio, the better the performance we can say is on the risk adjusted basis from this. So there are questions that if the market is correcting, how will the fund behave? So a simple way would be to say that if the market falls 5% a month, we may fall only 3% because we are 60%, 70% invested. But because we are selling call options of maybe 1.5%, 2% every month, so we may make 2% profit in that particular month. And because we fell 3% and made 2% profit, we may fall by only 1%. So when a market is gradually falling, this strategy is a great strategy because it falls much less than the market. And if the market is flat, we actually end up making more returns. I can give an example in this. For the month of May, if we see, the market was down 0.33%, Nifty 50 was down 0.3%, but the fund was up 1.23% because it had sold, almost 2% call option premiums that month. And on the equity side, it was down 0.6%, slightly more than Nifty, but on the derivative side, it made 1.85%. And we have seen in the past, if we see, we can share this. So Monica, you can share this slide if possible with everybody, because on a monthly basis, for example, in the month of August 23, the market was down 2.53%. The portfolio for the fund was flat, but because there were returns from the derivatives, in spite of the market falling by 2.5%, the fund created a return of 1.22% for the month. So almost a performance of 3.7% for that particular month. And it is a conservative strategy because we are mostly never fully invested. And this is a great data that, we normally assume that beating the benchmark is very easy, but this is a 1 month old news. You can Google it on the internet. The 88% of the large cap mutual funds fail to beat benchmark for a 7-year horizon. 1 year, 2 years is very, very different. But if you see for a long term, 88% of the large cap funds, even in India, have not performed well. And the story is not different globally. Now, this is, again, you can search it on Google, and we can also share the slides if you want. So if you will share your email ID, we can share this PPT or PDF with you. And this is the data for US, which shows, on the x-axis we have, let us assume 10 years. So over 10 years, you will see that almost 10, 11 or 12% of the funds, only 12% of the funds have outperformed the benchmark. So similar story, we said 88% in India did not perform. This is exactly the same figure for a 10-year performance. We don't have 7-year figure. So almost, if you see clearly, almost 87, 88% of the funds, even in the US, have not, beaten the benchmark. They have underperformed the benchmark. So it is not easy to beat the benchmark in the long run. And this data now is very, very interesting. If you look at it carefully, this is the data of what Nifty has done over the last 24 years. This is what Nifty has done over the last 24 years. So you will see, we've tried to divide it, the first 3 columns are when it has given negative returns, and the next 3 columns are when it has given positive returns. And you will see that, Nifty has given negative returns in the first, second, and third column, which is about 8%, 8%, and 4%. Roughly 20% of the time, only 20% of the time, Nifty has given negative returns. And if you see the next column, that is 0 to 12, is 24% of the time Nifty has not delivered a return, greater than an FD return, almost FD or a lower return. So we can say that 44% chances are there that Nifty will give negative or below 10% returns. And the average of these years is a shocking minus 7.5%. So, if you take average of these periods when Nifty has been below 12%, the average is minus 7.5%. So 44% probability is there that the portfolio may give negative returns or lower than 10% returns. So, this is a summary of the same. And you will see that 44%, chances are there that, we will have below average returns from the market. And 16% chances are there that Nifty will give 12 to 24%, which is very, very good returns. And more than 24% returns, has been a 40% probability, which, we have covered in the previous webinars, that Nifty will always, at certain time, when it goes up, it goes more than required, but when it goes down, again, it goes more than required. So it has excesses on both the sides. ऊपर जाएगी तो बहुत ज़्यादा ऊपर जाएगी, जो हम expect कर रहे हैं उससे भी ऊपर निकल जाएगी, पर जब नीचे गिरेगी, अगर उसको 100 से 80 पे 60 पे रुकना भी चाहिए, वो रुकेगी नहीं और नीचे जाती जाएगी. So it has extremes built in because there are number of people. We have short-term, long-term investors, traders, FIs, domestic institutes, operators, all kind of large funds, different people with different needs, investing short-term money, long-term money in the system, which causes the Nifty to be extreme on both the sides. When it is going up, it will go up more than required. But when it falls, when the sentiment is bad, it falls more than required. So, this is also very, very clearly, the data is also very clearly showing that there are a lot of extremes in the system. And we must also remember that if a market goes down by 50%, in 2008, we had a fall of 50%, 51.8%. 100 रुपए की चीज 48 rupees रह गई थी. So next year there was a bounce of 75%. People will say, wow, सारा return पूरा आ गया. But we have to see that 50 के ऊपर 75% return का मतलब है हमारा 100 नहीं पूरा हुआ, 87 ही है. It is still 13-14% lower than where we had started 2 years back. Still 13%, even after 75% jump. So these numbers have to be, they cannot be taken in linear way. We have to understand, okay, 50% going down, the market needs to go up 100% to come to the same money. So what does the Volvin do? Like some people are also asking. So on an average, if Nifty is down, let's say 10%, we may also be down 4, 5, or 6%. Like if it is an annual number, we may be down a similar number, 4, 5, 6% on the equity side. But because we are doing about 1.5, 1.6, 1.2% on every month by writing covered call options, there are chances that on the derivative side, we will make a 14 to 20% return, gross return in the year. So if Nifty is down 10%, we are also down, let us say 5%, but because we made 15% on the derivatives, we may still be totally flat or have a return of 5 to 8%. So it's a very conservative number. Actually, if we take 1.6% as what we are doing, and on a lower side 1.2% that we feel is achievable every month, a 1.2% will roughly mean 15% returns on the derivative side. So if Nifty falls 10%, we fall 5%, but because we made 15%, we end up at plus 10%. And if Nifty is flat, if Nifty does nothing, we are also on the equity side, we may not do anything, but again on derivatives, we may make 15 to 18% gross returns, thereby still, delivering more than the 12% return that Nifty does in the long run. And so these on the rightmost column are the numbers that the fund can deliver, and the fund has actually delivered similar numbers in the previous year. But again, note of caution that past performance is not an indicator of what the future performance can be. But we as fund managers try very hard to ensure that, we do good returns for the investors. And there are 84% chances, if you see the last slide carefully, there are 84% chances, except for the first two, where we will definitely outperform the Nifty, we will do better than Nifty. But if we are looking for returns, anything above 4%, this yellow number, the mark we are, chances are that 84% of the time, the strategy will outperform the benchmark. So this is the strategy of the Volvin Growth Fund in a nutshell, in one slide. On the left side is equity, and the right side is derivatives. So on the equity does about 14 to 15% returns in the long run. We can say an average of 14%. And on the derivatives, if we assume, we sell at the money call option, the premiums are very, very high. They are almost 4%, 3.5% per month. The returns are 42% a month. 42% a year. 3.5 annualized is 42%. But if we do out of the money call options, we earn about 1.5% premium. That is about 18% a year. So taking an average of both these numbers, on an average of 30% is what we can target from the fund on the derivative side. But I'm not saying we, actually deliver it. We have delivered about 16, 17% on the derivative side. But we, on a month-on-month basis, we try to, earn a premium of 3%, 4% a month. But why it does not materialize is because many call options, we have to exit the stock, thereby reducing our returns from that particular stock. And in the long run, if we simply take an average of 14 and 30, 14 is what equity does, 30 is what derivatives might do, we may end up at, about 22% or between 15 and 29, 15 on the lower side for a 5 to 10 year horizon, and 29% on a higher side for a 5 to 10 year horizon. These are annual numbers, but we are assuming that an investor wants to stay invested for long term for a period of about 5 years. And why 5 years is the magic number is also, we can check our earlier videos where we have shown that there is a 99% probability. There is a 99% probability that Nifty delivers positive returns if you are invested for more than 5 years. So any questions from this, please note down. We can answer in the Q&A session. So in the end, I would want to summarize that even though derivatives are considered as weapons of mass destruction, we are using derivatives in the alternate fund not to speculate, but the primary strategy is to, hedge the portfolio, buy puts in if required, sell Nifty index, index if required. If you are trying to, protect the portfolio. Before elections, we had bought a lot of puts. It was a huge cost of about 1.5%, 2% on the portfolio. But we knew that if things go wrong, we can lose 10% of the portfolio in one day. So spending 2% was not a bad option. And let me tell you, we did benefit from the big fall that we had where we could cash in some puts and also some portfolio where we were sitting on cash. So we were, I think, last month sitting at about 60% long. Monica, can you share what was the Jitin or Monica from the team? Can you share what was the long position earlier and what is the current long position for the fund? So if we see here, our long position was 59%. So almost 40% in cash, before the budget, almost 40% in cash. And I think currently we should be somewhere around 80%. So we have, used that opportunity where the market fell to add funds, add stocks to the portfolio. So on the equity side, we are very, very passive. We use fundamental investing and have a very diversified portfolio. But so currently the team shows that we are long almost 75%, and we were at one time almost 90, almost close to 100% long during the month. But we've been very quick to book profit because we feel the market is having a crazy run. We are in euphoria. So, it's having a crazy run. So we have booked, and from almost 100%, we are back to almost 75%, 74% currently. So we're trying to book profit wherever we're getting more than normal returns. And the portfolio is, again, like I showed you in the previous slide, is an extremely diversified portfolio. Mutual funds normally have 15-20 stocks. We have more than 60 stocks in the portfolio. On the derivatives, we are extremely active. On the equity side, our churn is less than mutual funds. Last year was probably 17%, something around 17%. And but on the derivative side, it was almost 200% churn. So as the fund is very, very passive on the equity side, the opposite side is there for derivatives. We have to be extremely active. We use technical charts. The team is good in understanding the technicals and uses technical charts to enter in a staggered way at the right time and trying to reduce risk whenever possible by buying put options or trying to sell some futures. And derivatives also is the most important theme because this is what is equity rentals. This is what earns us the monthly rent of 1.6% on an average each month. So unfortunately, mutual funds can use only 15% of their portfolio as derivatives. So mutual funds are also allowed to use derivatives, but they cannot use more than 15%. So we had to, not launch a mutual fund, but an AIF category 3 because we are allowed to use 100% derivatives on the portfolio in AIF Cat 3. So in the end, I would just want to say there's no such thing as bad weather, only different kinds of good weather. Thank you, and we are open to any questions, Kamal. So, So Anurag has asked, how is the risk in covered calls different from uncovered call writing? So uncovered call writing, you have unlimited risk. If I write a call option for 4 rupees, it can become 20, 50, 100, whatever. We have seen in index 1 rupee option becoming 200 rupees. So that's a big risk. We do not do that. We are a risk averse fund, and our strategy will not be risky because we have the stock. In case the option goes up, from 4 rupees to 20 rupees, we will in fact cover that 20 rupees from the stock we own and pay off to the option buyer. So we will never lose money if the stock moves up. If the call option goes against us, we will never lose money if we have the underlying. Only in case if we have shorted some extra call options, only then there is a risk of losing money there. Yes, Kamal.
No, I think this has been very interesting webinar. I had run this poll, to understand what is the understanding about covered call strategy amongst the audience. Initially, there were only 30% people who were mentioning that they understand covered call strategy, and then obviously that number increased. But I still feel number did not go beyond 50%. So there needs to be, I think, a release of a one-page note from your side on what exactly is a covered call strategy, which we can circulate amongst all these people who have joined today with us. And I also see there is a lot of interest amongst investors, because it is correct that markets are high, and that is what obviously making many investors who are today logged in know more about this strategy. To understand from you, Vineetji, I want to put some stress on that particular aspect of highest Sharpe ratio when you mentioned, because there are so many funds in this entire industry which have acquired massive AUM. I do not know, what is your vision, but long short, as a category, has names like Edelweiss, names like Vendors, emerging names like ITI. Tata has over last 1.5 years, 2 years, added more than 2,000 crores of assets. ICICI long short fund has added a lot of assets. You are a new fund who is actually doing something very different and meaningful. So I want to understand from you, these two aspects. One, what is your vision, in this entire competitive industry, and what do you think, is the quantum of AUM that you think can be done in a covered call strategy? Because this sounds to be a too niche and too, I would say, boutique strategy. I could be wrong. And at the same time, when you call your strategy number one on Sharpe ratio, what do you mean? What do you mean by that? And how do you say that? We are comparing yourself with whom? Number one amongst whom?
So, if you can allow me to present, can I have the presentation and I can,
Yeah, sure.
slide on that. Monica, what is the slide number for Sharpe ratio? So, Sharpe ratio is an ratio that was devised by Nobel laureate William Sharpe, and it takes into account both the standard deviation. So standard deviation, so in the world we live in, risk is defined as how volatile your portfolio can be. For example, if we have debt, the value of the bond will not change every day. It may change for a small variation, but there will not be a big change. So an equity will be more volatile. Markets go up, down. Every day there's a 0.5%, 1% change in the price. So the volatility, how much the movement in the underlying asset or the share or the stock is there, जितना स्टॉक ऊपर नीचे जा रहा है और मार्केट से अगर ज्यादा जा रहा है, उतना volatile और उतना risky माना जाता है. Because if the market goes up, there are chances it will go up more than the market. But when the market goes down, there are chances it will go down more than the market. So Sharpe ratio is a measure which evaluates the risk-adjusted return of an investment or a trading strategy. What it does is that it measures the risk in terms of beta and standard deviation for the whole portfolio. We can do it for individual stock, but it does for the whole portfolio, and also measures the return it has given, and compares it to the benchmark. So it is not that, what returns you are giving is great. So it will say that, okay, this was the benchmark, and let me check what are the returns you delivered compared to the benchmark. And it will use both the standard deviation and returns calculations to measure what is the ultimate Sharpe ratio. So the Sharpe ratio, I will show the comparison. And why it is less in our particular case is the reason, so you have a very important question. So it is very least understood. So we know from the past data, we can see videos from the market. Can I have that slide? Sorry. We can also search Google. Atul Suri, I will say, has had a beautiful video on the Z, wherein he has showed that the small caps will perform amazingly well when the market is going up. So 4 years, 5 years, they will do amazingly well, more than what the Nifty will do. But when the tide turns, when they start going down, all the 4 or 5 year gain will just evaporate. So we have tried to be very cautious. One is, the first thing is that, only 70 rupees on an average are invested. So if we are 70 rupees invested, there's automatically 30% lower risk. The number of stocks in mutual funds are 15, 20. For diversified, they are more. So our stocks are 65, which shows extreme diversification. And the biggest thing, what we are doing is selling call options. So even when the market is stagnant, so in equity, if you put a money in mutual fund, the mutual fund or the stock price has to go up. For us, we say no. The best scenario is the market remains wherever it is. So if the Nifty remains at 22,000, there only we are going to have a bumper month. All the 3-4% options return will come as profit. So if the market falls, let us say 5% in a month, we will fall only 3% because we have cash. And because we have written call options of about maybe 2-3%, 4% in that month, everything will come as profit and we will end up being flat. We will not lose money. So what we are doing is, it is not what we are doing, it is the strategy is a conservative strategy, because when the market goes down, all the options written comes as a profit. So that is the biggest thing which is helping us, helping the fund have a fabulous Sharpe ratio of 2 plus. It is 2.04, highest in the country. So you can see it's a Sharpe of 2.04, and risk-free rate, to calculate it has been assumed as 2.04. Has been risk-free rate is 7.7%, 7.16%. And the next question you had was how big the strategy can get. So there are, I will just say two things. Equity market in India is $3 trillion. In USA, it is even bigger. It's about $10 trillion or maybe more. But even in US, about $500 billion funds are there which do covered call option writing. In India, this number is, we have just begun. So the story has just begun. And I'm sure at a $3 trillion, we would expect in the next 3 to 10 years, this number should be close to at least couple of lakh crores, bigger than the current AIF total industry is. And we would request SEBI and other people to see the merits of this strategy, the low risk, and SEBI should in the long run also allow a common man to start investing, to be able to be invest in this strategy, because the current ticket size for AIF's category is 1 crore rupees. So we would want a common man to actually benefit from this and realize that this particular strategy should be allowed to probably even the mutual funds, so they can help the common man in creating higher returns and with lower risk. So this is, I would say, we broadly had two categories, debt and equity. So this is a strategy that is between that. It has, much lower risk, but the returns are similar to what equity does in the long run, or, even higher. There are chances that by selling these call options, the money generated by selling call options can be even more than 12 to 15% that Nifty does. We showed that slide where 18 to 22% returns over the long run are possible in this. And good things, they say, somebody has said, I don't know whom, good things take time, but great things take a little longer. So we are very hopeful that this strategy is adopted by more conservative people, more people who are investing in property, understand that this can create a huge alpha where a property can create 10-11% return. This strategy has potential of creating double the return from that in the property. And let me try to remind, Monica, can you tell me the slide number for compounding? So the figures, these a small alpha of 5-6% more creates a huge number in the long run. Let me try and get that slide for you. So there's a lot of data, I think, which we have covered in the past sessions. But so this is one thing that I was saying, that returns from stock market are not linear. When sentiment is good, market will go up more than required. But during adverse sentiments, markets will correct more than required. And currently, we see in the cycle of market emotions, we seem to be sitting near euphoria, because most people believe, especially the small investor, the not knowledgeable investor, believes that markets are not going down and they will make unlimited returns in the long run. So slide 43, can we, Monica, move to slide 43? It's taking some time, I think another. Yeah. So you will say this is an amazing slide. It is long term. We've considered one generation of 25 years. So inflation also in 25 years will become 5.43 crores. So whatever we are buying for 10 rupees today will become 54 rupees, more than 50 rupees in 25 years. So if we are investing in FDs, the first row, we are actually destroying 40% of the wealth. So imagine such hard earned money put into FD for long run. We can have FDs for short term. The need is there. We must definitely consider FDs and fixed return investments. And especially at this time when the market can crash in a very big way. So, that is the time when we can think of FDs. Nifty in the long run delivers 11.7% return after tax. In 25 years, it is 11 times. But we have to note that inflation, Mengai is also 5 times. So Nifty will create double the money than, inflation. So we have double the buying power. But if we are more prudent and we can have a strategy of, let us say, timing the market, if we are prudent, if we are smart enough to time the market or have a covered call strategy that may deliver, over a long run 22% return or 16% post-tax return, this amount is 8 times that of inflation and 4 times that of Nifty also. 4 times. And imagine 2 generations. 8 into 8, 64 times. So if somebody wants to invest for his, his children, his grandparents, especially for the children, you can have a long-term horizon. You put some money in for the long run in a strategy or a equity rental strategy or covered call strategy, you can possibly be 64 times wealth created in 2 generations. That is the kind of compounding, the power, the purchasing power, you will have. So we recommend that invest for long run, invest for your children. And let me also inform Kamal that we have had a great interest. People are telling us that, I want a rental also. So in this fund, there is only growth option. But let me tell you that in the next 1 year, we will have another fund which will be giving out about 6-7% as dividend, as an income for the people, and retaining 10 to 12% for long term. So, they say that you cannot have the cake and eat it too. So it's probably going to be a situation where you will also eat the cake and have the cake too, because you will be getting 6-7%, almost similar to FD returns in a year, and will be parking the balance money for long run, which will be compounding at, what Nifty does, 11-12%. So we feel, but it's a personal thing that, the data we have, and it's a personal feeling. It's not an advice. I will request everybody to consult your advisor and ask him where we are wrong, because we've been doing it for many, many years and we've been doing, decent returns. And if somebody can pinpoint that this is the way strategy will not work, there'll be something a lot to learn. But we have been in the market for 30-35 years and we have done a lot of hard work in, telling that this strategy can deliver a great alpha and returns over long periods. I hope I have answered your questions. Any other questions you may have?
Absolutely, Vineet, you have answered the question. One last question that, investors are more always, I would say, valuing what is the money that they're making in their hands after fees and after taxes. And there are domestic investors and NRIs. If you can maybe differentiate, what will be the returns net in the hands of a domestic investor and maybe an NRI investor from your strategy, and how will costs and taxes impact, in your fund in both these type of investors?
So this question does not have a simple answer. So what we say is we are a hybrid fund, and our taxation, like short-term taxation, is 15%, and long-term is 10%, but MMR for the funds like us is 39%. So we will fall somewhere between 15 and 39%, and especially if the market is going up, our taxation will be close to 15-20%. But if the markets are going down, let us say the Nifty crashes by 10% in the year, and you will see most of our income will come, let us say 15-20% of the option premium will come from derivative side. So a 20% pre-tax return will translate into 12% post-tax return. But that will come in a scenario where the Nifty has not done anything. So wherever Nifty keeps on going up, our equity portfolio also keeps on getting the long-term taxation and short-term taxation. But if the market crashes, we will suddenly be, faced with 39% taxation. But we don't mind. If Nifty has crashed and not given any return, all the returns have come from derivatives. I don't mind paying that higher tax. So automatically that system is built in that, but I am not sure about how much taxation difference would be for the NRI. So you will have to allow the team to respond to that query.
Sure, Vineet. I think this is very interesting, and absolutely, in the world of alternatives, we will see a lot of more innovation. As you were mentioning that you are launching new fund, which will be giving some dividends also, and all the best to you. And I'm sure there is a lot of personal, I would say, requirement at your end, because you have been an investor for 20 years and you created this for the real requirements of investors, and it is absolutely realistic. I am also one of the investors who knows that yes, equity markets throws, I would say, sentiments of greed and fear, and one keeps generating liquidity. One has to park liquidity, one has to invest liquidity, one has to invest that with various investment objectives. And given your product in terms of its risk adjusted return profile, it is very interesting. It's like we will see over time how much ultimately it creates as wealth. If you could maybe just in the last 2 minutes also explain what has been the net return, net of taxes in the hands of investors, like in last 2 years since you have kind of started this fund. What has been the return which has actually been created by your fund in the hands of investors?
So last financial year, can I get the PP RR report? RR. So I know the figures were 30.3 or 5% gross returns, but post-tax, post-expenses, post-management fee, the returns were about 25.1%. So about taxation of 15-16%. So which is not very, very high considering we are an alternate fund and also having huge income from derivatives. In the previous year, it is a great example. We were existing only for 6 months, but during those 6 months, Nifty was flat. And if you want, you can put that slide. Nifty was flat, but we had about 7% return during those 6 months. Nifty was flat, which meant an annual outperformance of almost 14-15%. So the annualized returns were 14-15%, but taxation was around 23. That time it was short term, so the taxation was full taxation, and even during that, I think we ended up having 7-8% post-tax returns. But we did not have a single redemption even then. So the investors did not redeem, and those investors, when we became 1 year old, the taxation suddenly reduced because we were, as our fund accountant team and our tax consultant, they suggested that for 1 year, let us assume the taxation at 39%. So I'm just checking the figures for 31st March, Nifty was up almost 1.5%. The fund was up 6%, so 4.5% outperformance. So taxation was 39% that time because we were less than 1 year old. But because the fund is now more than 1 year old, we have a mix of, like I told you, long-term 10, short-term 15, and derivative 39. So we should be somewhere between 15 and 25% in the long run taxation. And returns expected over 5 years, gross returns should be between 20 and 22% over 5-year period, between 20 and 22%. And post-tax return are internally we target a post-tax return of 12 to 15-16%. We have been doing much more than that. Last year was 25, but internally we feel that between 12 and 16% post-tax and expenses are possible, similar to the example we have given in the long run. If you are invested for 5 to 10 years, then we can potentially give 12 to 16% post-tax returns also.
Understood, Vineet. I think this is a very good fund for those investors who aim to invest in index funds or maybe large caps. it definitely delivers better value add to some of those investors, and also conservative investors who are like undecided that when to invest in equity. When markets are high, they kind of feel valuations are high, and when markets are low, obviously uncertainty kind of stops them from investing. So this fund is an answer to both these types of investors, and
And
absolutely
even and
interesting.
even Kamal, people who are investing big time into property के प्रॉपर्टी में पैसा मरता नहीं है, बिल्कुल नहीं मरेगा, 10 साल में तो इन्फ्लेशन ही आ जाएगी. पर property, we have to know now that in 2000 our population growth rate was very high. Fertility ratio was 3.25, which meant one couple had 3.25 बच्चा, 3.25 kids. And 2020 our fertility ratio was only 2.05. We are possibly below 2 right now. मतलब एक कपल का एवरेज 2 बच्चे भी इंडिया में नहीं हो रहे हैं, एंड पॉपुलेशन इज गेटिंग स्टैग्नेंट, which shows कि वो जो unnecessary या more demand थी due to increase in population is possibly not going to be there. So property may not be delivering that good returns in the long run. So we are not sure, but this is the data that I'm sharing, that fertility ratio in India is almost flat right now. So one must diversify and invest in equity for long run, so that huge wealth can be created. जैसे property में होती है, equity के अंदर उससे ज़्यादा है. The numbers clearly suggest the compounding is much more in equity.
Sure, Vineet. I think this is a very interesting discussion. Thank you for spending time today. Thank you, everyone. We had a lot of queries. I have dropped in our book a call appointment link for all those interested investors who want to know more or want to have a one-on-one conversation with Mr. Vineet Jainn on this fund. You can contact us at PMSAF World. I have shared on the chat book a call link. You can just click that link and book your appointments with us. Thank you, everyone, for joining for this webinar today. Thank you, Vineet ji, for your time.
Thank you so much for your time, everybody. Thank you, Kamal, for the opportunity.
My pleasure.